For FY13, Government of India has decided to cut the borrowing program. So what are the expectations for FY14 at a time when inflation is high, government finances are not in place and growth is yet to kick in? Let's discuss this topic with Manish Vadhavan, Managing Director and Head of Interest Rates with HSBC. Along with him, we've got Vivek Rajpal, Rate Strategist with Nomura. And in just a bit, we will also be joined by Dhaval Dalal, EVP and Head of Fixed Income Group with the DSP BlackRock Investment Managers. Gentlemen, good to have all three of you on ET Now. Thank you for joining us. Manish, let me kickstart the discussion with you. Government has slashed the FY13 borrowing program. That's great news. But it's too early to assess what will happen to FY14.
Yeah, that has been one of the positive news for bond markets this year. But, it's one auction being cancelled, so it's not something too great or too big out of the overall supply. The key takes for next year is that in continuation with what the FM has committed himself regarding the fiscal deficit numbers, the market expects that the fiscal deficit will be controlled at 4.8% of the GDP for next fiscal year. That translates into a gross borrowing number of something like 5,75,000 crores, plus minus 10,000. That is the ballpark number what we get. It doesn't add any cheer to the market because it's a pretty large borrowing number, but it is definitely better than, the kind of increases what we have been seeing. This year's, the current fiscal year's borrowing plan was 5,70,000. They've cancelled one. So it's 558 what exactly has gone through. So the number should be around 575 centric for the next year on central government gross borrowing numbers.
Okay, let's also welcome in on board Dhaval Dalal, EVP and Head of Fixed Income at DSP BlackRock. Dhaval, hi, morning. Finance Ministry officials have stated that the government gross borrowing of 6 lakh crores. Is this in line with your estimates?
Well, I think most of the market participants would like to see the borrowing number a tad below 6 lakh crore handle. I think the moment the number prints at 6 lakh or higher, I think the market sentiment could slightly get dampened given the fact that that will put a spotlight on the RBI's role going forward to support the borrowing program in terms of demand supply. And that's very important. So I think most of the market participants would like to see a number somewhere like between 580 to 590.
Vivek, do you expect anything in this year's budget for FY14 bond buyback program?
Yeah, so I think the 6 trillion number that has been talked about in the media regarding gross borrowing includes INR 400 billion of the bond buyback program. That is the only way 6 trillion number makes sense with a lower fiscal deficit. Our estimate is that we will see a 4.7% of a fiscal deficit, and the 6 trillion number which is there in the media reports, if you combine that with the 4.7% of a fiscal deficit, the only way it can be if we have an extra 400 billion accounted for the bond buyback by the government.
Manish, 6 lakh crore for next year, do you think that is a tad optimistic number? That means somewhere government is assuming that for FY14 growth will surprise on the upside?
I think it's a bit holistic discussion which we need to do before we come to some kind of a conclusion on this. The big picture is that we have a presumption that Finance Minister will control the fiscal deficit number in the budget, and whether that number is 4.6 or 4.7 or 4.8, the gross borrowing number would be between something around 5,75,000 what we are coming around to by doing all kind of combinations. But one of the important points which is being missed out is the state government borrowings have become a very large parameter for the supply in the system. Why I'm raising this is because the next year borrowing is approximately going to be something like 2,35,000 crores from state governments and 575 what I talked about the central government. This in all creates a gross supply of 8 lakh crores in terms of SLR supply. The state government bonds are eligible as an SLR. So there is a lot of demand on SLR which gets met by the state loans also. And even if we talk about the net supply, what we discussed, what the gentleman was raising, we have a gross supply of not less than 6.5 lakh crores, which is a very large number. The only hope which has been, for the last 5 years, if you see, RBI has been buying back through OMOs approximately 25 to 35% of their borrowing every year. So this gap actually still remains. So till the time you expect that RBI is going to continue with this kind of a thing, and so then this can go through. Otherwise, it is still a large number. Second point, coming to your the growth projections. See, the expectation for this year's after the revised estimates of GDP for this current fiscal has been already given. The overall gross GDP number would be somewhere around 1 crore what we are talking about. And even if we presume 6% growth and a 7% inflation or 6.5% inflation, it would be an overall nominal GDP growth of between 12 to 12.5%. Beyond that, I think it will be difficult even for the finance managers at Ministry of Finance to predict. So I think that is the base case scenario, around 6% growth in real terms and 6.5% inflation. So nominally around 12.5% growth for the next fiscal. Now, there is a lot of tweaking which would need to be done in terms of expenditure, etc., because there are so many things which are automatically going up, like the interest payments, which was around 3,16,000 or 320, is expected to go to something like 360, where they have no control. So government will have to show some real spine in terms of cutting subsidies or what they're talking about, or something is being talked about that the petrol diesel subsidy would be capped. Unless and until they achieve this, even with a 10% reduction in the plan expenditure will not do any major trick. The size has become so large that you really need to take very hard decisions.
Vivek, what is your sense in terms of what you're expecting on FY14 net borrowing front? And do you think net borrowings for the fiscal are likely to be lower than FY13? Because the government is likely to consider, 40,000 crores of bonds, and they also need to manage record redemptions over the next 12 months.
So exactly, that's what I was saying. 6 trillion gross supply would include 40,000 crore of the bond buyback or the redemptions which were due in FY15. So effectively, this is also equivalent to redemptions, and hence one should view those 40,000 in line with the replacement demand. In terms of net supply, we'll still have a 4.7 trillion of net supply if I adjust those 40,000 crore only in the gross supply. So 4.7 trillion or 4,70,000 crore of net supply is equivalent to last year's 4,70,000 crore of net supply. So overall, our sense is that 6 trillion is definitely not a happy number for bond markets. You can give fiscal deficit number less than 4.6%, of bond markets care about the borrowing. And if you give a 6 trillion number of a 6 trillion gross borrowing number, the first reaction will not be so positive in the bond market, especially heading into the first quarter of the next fiscal year. So our expectation overall is that the first reaction of the bond markets will be little bit of nervousness. Let us not forget that the positioning in the market is long, and probably bond yields will tend to inch up a bit as we head into the supply. Having said that, we are still in a monetary easing environment. We are still have the hopes of open market operations in the coming year. Net supply is still 4.7 trillion, which was the case even last year. So it's not as if bonds will sell off big time, but one should expect, in our view, to expect some kind of a supply concession getting built into the yield curve. At the moment, we are working with a range of 775, 795, and I'll not be surprised if we see the higher side of the range heading into April.
Fair point. Dhaval, just want to get you in on this. To what extent do you think the bond yields can fall further? I mean, what is your view over the near term as well as FY14?
See, our base case is that we believe that the RBI is likely to reduce the benchmark rates by only one more time, that too by May. We do not expect the RBI to reduce in March. but will cut by 25 basis point in May and then remain on the sideline because of the inflationary pressures and current account deficit. With that base case, I believe that what is going to happen is that your supply is going to be front-loaded, and that is likely to result in a steepening of the yield curve. So we do expect the spread between short-end and long-end government bond yields to start widening. And with that thought, we believe that the benchmark 10 is unlikely to fall significantly below 770, and it's likely to remain between 770 to 790 in the medium term.
But Dhaval, broadly the bond markets are positioned on the long side. So are we in for a budget disappointment then?
I don't know whether you would. It's too premature to talk about disappointment. What we know for sure is that whatever the number is going to be, I think the sentiment may get disturbed a little bit. But I think the RBI could step in at just like what they did last year through open market operations, bond purchases, and may calm the nerves. Having said that, I think the supply is going to be more towards the long end, and that should result in relative underperformance of long end over medium to short end. That's what I think is going to be the key element to take away from the entire exercise.
Okay, gentlemen, we'll leave it there. Dhaval, appreciate your time. Thank you for your insights. Vivek, thank you as well for your robust and wonderful insights. Manish, thank you for your time and glad you could join us today.